What is a Pigouvian tax? A Pigouvian tax, also spelled Pigouvian tax, is a tax levied on any market activity that generates negative externalities. A negative externality is a cost imposed on a third party who is not directly involved in the production or consumption of a good or service. The purpose of a Pigouvian tax is to internalize these external costs, meaning to make the producer or consumer of the good bear the full social cost of their actions. By increasing the private cost of the activity, the tax aims to reduce the quantity of the good produced or consumed to a socially optimal level, where the marginal social cost equals the marginal social benefit. Suitable examples: carbon tax, a tax on greenhouse gas emissions, typically imposed on fossil fuel producers or consumers. This tax aims to account for the environmental damage caused by carbon emissions, such as climate change, which affects everyone. Pollution tax, a tax on industrial activities that generate air or water pollution. For example, a factory might be taxed for the amount of pollutants it releases into a river or the atmosphere. Tobacco tax. Taxes on cigarettes and other tobacco products are often considered Pigouvian taxes because they aim to address the negative externalities of smoking, such as the burden on public healthcare systems from smoking-related illnesses, and the health effects of second-hand smoke on non-smokers. Sugar tax, a tax on sugary drinks or foods to discourage their consumption, aiming to reduce public health costs associated with obesity and related diseases. Congestion tax, a charge for vehicles entering congested city centers. This aims to internalize the cost of traffic jams, increased travel time, and pollution caused by excessive vehicles in urban areas. Origin of this concept. The concept of the Pigouvian tax originated with the British economist Arthur Cecil Pigou, 1877 to 1959. He first proposed this idea in his seminal work, The Economics of Welfare, published in 1920. Pigou recognized that in a free market, when economic activities create costs for third parties, negative externalities, that are not borne by the producers or consumers, the market tends to overproduce those goods. He argued for government intervention, specifically through taxation, to correct these market failures and achieve a more socially efficient outcome. Advantages and disadvantages of Pigouvian tax. Advantages. 1. Internalizes externalities. The primary advantage is that it makes producers and consumers account for the full social cost of their activities, leading to a more efficient allocation of resources and reducing harmful externalities. 2. Generates revenue. The tax revenue collected can be used by the government to fund public services, invest in projects that mitigate the externality, e.g., environmental cleanup, or reduce other taxes. This is sometimes referred to as a double dividend, improving the environment and raising revenue. 3. Encourages innovation. By increasing the cost of activities that generate externalities, it incentivizes firms to adopt cleaner technologies and more sustainable practices to reduce their tax burden. 4. Market-based solution. Unlike command and control regulations, e.g., setting strict limits on pollution, Pigouvian taxes provide flexibility. Firms can choose to reduce their output, invest in abatement technology, or pay the tax, allowing them to find the most cost-effective solution. 5. Efficiency. It leads to a more efficient outcome than a free market with uncorrected externalities, moving the economy closer to the socially optimal level of production. Disadvantages. 1. Difficulty in measuring externalities. One of the biggest challenges is accurately quantifying the exact social cost of an externality to set the optimal tax rate. Many costs, e.g., health impacts, environmental degradation, are complex and difficult to measure in monetary terms. An incorrect tax rate will not lead to the socially optimal outcome. 2. Regressive impact. Pigouvian taxes can disproportionately affect low-income households, as they may spend a larger percentage of their income on goods that are subject to these taxes, e.g., gasoline, electricity, or certain food items. This can lead to issues of equity and social justice. 3. Political opposition. Imposing new taxes, especially those that increase the price of essential goods or services, often faces significant political resistance from industries and consumers. 4. Potential for tax evasion, black markets. If the tax is too high, it might incentivize illegal activities or black markets to avoid the tax. 5. Uncertainty of behavioral response. It can be difficult to predict how consumers and producers will respond to the tax, making it challenging to achieve the desired reduction in externalities. 6. Greenwashing, or misuse of revenue. While revenue can be used for beneficial purposes, there's no guarantee it always will be. Concerns about how the revenue is spent can arise. Economic implications of Pigouvian tax. The economic implications of a Pigouvian tax are significant. Market correction and efficiency. The core implication is the correction of market failures caused by negative externalities. By internalizing external costs, the tax makes the private cost align with the social cost, leading to a more efficient allocation of resources and a reduction in the overproduction of goods with negative externalities. Price and quantity adjustments. The tax increases the price of the good or service that generates the externality. This higher price discourages consumption and production, leading to a reduction in the quantity supplied and demanded. Impact on producer behavior. Firms are incentivized to invest in research and development of cleaner production methods or alternative technologies to reduce their tax burden. This can foster technological innovation. Impact on consumer behavior. Consumers face higher prices, which can lead them to reduce their consumption of the taxed good or seek out substitutes that generate fewer externalities. Revenue generation. The tax generates revenue for the government. How this revenue is used, e.g., for environmental projects, tax cuts elsewhere, or distribution to affected parties, has further economic implications regarding public finance and income distribution. Distributional effects. As mentioned in disadvantages, the burden of the tax may fall disproportionately on different income groups, leading to questions of fairness and potentially exacerbating income inequality. Policymakers often consider ways to mitigate these regressive effects, such as by rebating the tax revenue to low-income households. International competitiveness. If a country implements a Pigouvian tax, like a carbon tax, that its trading partners do not, it could potentially disadvantage domestic industries in international markets. This often leads to discussions about border adjustments or international agreements. Double dividend potential. In theory, the revenue from a Pigouvian tax can be used to reduce other distortionary taxes, e.g., income taxes, potentially leading to both environmental benefits and an overall increase in economic efficiency. Meaning of Pigou effect. The Pigou effect is a different economic concept from the Pigouvian tax, though both are named after Arthur Cecil Pigou. The Pigou effect refers to the stimulation of output and employment caused by increasing consumption due to a rise in the real balances of wealth, particularly during deflation. Here's how it works. In a period of deflation, falling prices, the real value of people's nominal money balances, cash, bank deposits, and government bonds increases. This makes individuals feel wealthier, leading them to increase their consumption. This increase in aggregate demand can then stimulate output and employment. Essentially, Pigou argued that if prices were flexible, deflation would automatically increase real wealth, thereby boosting consumption and preventing prolonged periods of unemployment, even in situations where Keynesian theory might suggest a liquidity trap, where monetary policy is ineffective. It's often referred to as the real balance effect. Key distinction. Pigouvian tax, a government policy, a tax, designed to correct for negative externalities. Pigou effect, a theoretical economic phenomenon describing a self-correcting mechanism in the economy during deflation due to changes in real wealth.